Berkshire has $350 billion worth of ready cash, much of which is available to share buyback.
Part 2 of our interview with Tom Russo is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. On May 3rd of this year, Warren Buffett made the surprise but long anticipated announcement that he was ready to retire as CEO of Berkshire Hathaway and assume a less active role. However, the nonagenarian still plans to go to the office on a regular basis. As longtime Wealth Track guest, the intelligent investor columnist and veteran Buffett follower Jason Zweig put it in the Wall Street Journal, there's only one Warren Buffett, and there will never be another. We will provide a link to Zweig's excellent column on Buffett on our website, wealthtrack.com. This week's guest is a longtime holder of Berkshire stock and has been an avid student of Buffett's style of value investing ever since meeting the legendary investor at Stanford Business School in the early 1980s. He is Tom Russo, managing member and chairman of investment advisory firm Gardner Russo & Quinn, where he oversees his Semper Vic Partners funds, which he decided to launch in 1983 after hearing Buffett address his Stanford class. The global value manager focuses on owning a small group of exceptionally well-managed, well-known brand name firms, many family-owned, with dominant, almost unassailable positions in their mostly consumer-oriented businesses, and then holding them pretty much forever. Berkshire Hathaway is a case in point. One of his earliest investments, he first bought some in 1984, it is now one of his largest positions. I asked him to discuss his brand of value investing and the rare qualities he looks for in order to invest. But I had to ask him about Berkshire. With Buffett retiring, how does he view Berkshire now?
We always knew that this moment would be upon us, and now that it is, we have various reactions. On a personal level, I couldn't be more disappointed because we will miss that interchange, really, between Charlie and Warren.
Yes.
And this wonderful story is every Friday afternoon they would meet, and Warren would come bursting in with an idea, and he'd say, "Charlie, you have a second? I want to tell you about this great idea." And they go through it all, and Charlie at the end looks up and says, "Warren, that's the dumbest idea I've ever heard." And so Warren said, "Oh, geez, Charlie, I'm so sorry for wasting your time, but do me a favor. You take it home over the weekend, and then let's just convene on Monday." And Warren comes in. Charlie's already at the office, perky, and he opens the door and says, "Warren, you were brilliant. That's the greatest investment I've ever heard." And so Charlie converts over the weekend based on the merits of Warren's reasoning to support Warren's plans. And so when Warren knocks on the door, sheepishly thinking he'd be criticized for wasting Charlie's time, Charlie said, "Warren, that was the best write-up of any company I've ever seen, and let's do it."
That's such a great story, and it's so emblematic of what their entire relationship was.
Yes, yes. It's also what all Berkshire shareholders hope in some ways might be replicated in the post-Warren era. It would be possible for the new CEO,
right, Greg Abel,
right, to recourse judgment from Warren, who'll still be around and on the payroll. And so that's the hope. Warren has had such an impact on the success of our investment. Kevin Clayton, the head of Clayton Homes, when he was acquired, I went to Berkshire Hathaway annual meeting. I spent time with him the first year. What's it like now that you're part of the fold? He said, "Well, it's amazing. Anytime I have a capital allocation decision, I just call Warren, and he sends down the indefensible airplane and it brings me up so that they could talk." And inevitably, Warren would ask 3 questions, and by the end of the second question, Kevin knew the answer. And it was because Warren framed questions and knew what points of choke were. So the avoided mistakes of capital allocation, and I put that all on Warren's shoulders for being such a good counselor. to his CEOs, 80 of them. There are 80 different compensation schemes at Berkshire, handwritten by Warren in sort of a page and a half, not like the 300-pound books that the CEO of General Motors might get.
You've just made the case for why it's going to be really different when Warren Buffett is no longer the CEO, or when he is no longer, really able to keep up with things. He's 94. So,
yes.
Let's get real here. And Jason Zweig, who is a wonderful financial journalist, writes the Intelligent Investor column for the Wall Street Journal, has been a
great.
longtime follower of Warren Buffett. He wrote an article when Warren retired, which we will have on our website. There's only one Warren Buffett, and there will never be another one. And he gave 3 reasons. And one is how brilliant and stock-obsessed Warren Buffett has been, basically investing since he was 9-year-old. And that's all he did. If you read some wonderful biographies of Warren Buffett, you'll know that sacrificed his family life, his social life, everything else for many, many years, and because he was so stock-obsessed. But he wanted to do it. He loves it. And also the period of time that he lived in post-World War II, and he invested in a lot of companies that were not well researched. And the third thing is the package of that Berkshire Hathaway. There was no agency cost. The decisions were made internally. There were no management incentives that they had to worry about. There was no short-term thinking. So that whole package, Jason said there will never be another Warren Buffett. Guess what? We're at the tail end of Warren Buffett's career. Why Berkshire still? Why do you think it's going to continue?
I expect that they will have muscle memory when it comes to the most critical variable that kept us at such a large investment in Berkshire in the first place, lack of agency cost. That's terribly important, and they start with an undervalued share, as there has been sort of a well-proclaimed knowledge that at some point we will lose Warren Buffett. And that fear has been built into the share price. Berkshire has $350 billion worth of ready cash, much of which is available to share buyback if for some reason it happens that there's a sharp downturn following news that might affect Warren's health. Good news for remaining shareholders is that Warren already began share buybacks 3 or 4 years ago. And it's so valuable symbolically. If he never made the share buyback during his lifetime, he would have had terrible pressure to try to do it after he passes. As it is, he can simply say that it's the same that they did previously, and it's part of the value creation. If he buys the shares at a 25% discount, the premium, the discount gets spread over the remaining shareholders, and that's what we expect would likely be the course of action. There's never going to be another Berkshire chairman like Warren. One of the things Warren likes to say is that he doesn't necessarily go out and kick the tires and travel to meet companies. There are 100 companies within Berkshire, plus the Marmon companies, and he doesn't travel up to see them. Greg does. And the fact is that Warren did not have to do it, because he was able to secure his outcome from those managers, not by going out and periodically visiting, but by crafting the appropriate compensation package with each of them. And that's when I said the critical point was that they had flexibility of making sure that they incent the right behavior in each of the various discussions that he has. And that makes a big deal. A really important element of this is often missed, which is that what Warren tells his division heads is that they should invest every penny that the business ought to have to maximize its operating margin and its competitive moat. But it shouldn't have any more. And so the most pressing claim in Berkshire is send cash to Omaha. Because in most conglomerates, you end up with this drive to try to diversify and get synergies between various enterprises and all of the rest. And Warren's feeling is a portfolio full of properly incented, able managers pursuing the shared quest that Warren highlights when crafting what the terms of that manager's benefit and salary would look like. What you don't have is Kevin Clayton, who's Clayton Homes, does a great job with manufactured housing, left over with $200 million at the end of the year and trying to figure out where to deploy it because he has no background in deploying capital outside of buying another 15 different manufactured homes sites.
Right.
And that's terribly important. The last thing is, it's on a soft side, is up until now, and during much of his time, Warren had the wisdom to allow the operating managers to continue to have standing in their community as if they were still the number one person in the universe relative to that company. Often the deals that break do so on sort of command and control basis more so than financial performance.
And why is that important?
It's their business, and and by the way, all of those features are so terribly appealing for the seller that Warren would like to buy, that they end up seeing deals before anyone else and closing them privately, and the seller feeling great, even though there's a whisper that he could always have gotten more. The truth is, he got what he wanted because he could fill up the bank account, he could continue to run the business. He continues to be the standing in town that he felt he long grew comfortable with, and so that's the soft stuff. Now, we do get a known individual, so we don't have to. That's one of the positives of how this has transpired.
With Greg Abel.
Exactly. He's a guy who's totally vetted.
Let's talk about some of the things that you do that really are very unusual. I mentioned in my introduction to you that you have 16 companies, portfolio companies right now.
Yes.
It's always been very limited. You have a number of attributes mean that it's going to be a very small group of companies that make the grade as far as your Semper Vic standards are concerned. One of them is, you've mentioned before, avoid agency costs at all costs. You've got that in capitals. Agency
cost stems from an expression Warren had when he came to our business school class and said, you can't make a good deal with a bad person. And the longer you stay attempting to do that, the more you'll be disappointed. It's the propensity of partners who you probably ought not to partner with, who may wish to favor their interests over the public market's interests, and more importantly, over the company controlled shareholders' interests. What you're trying to do is build long-term wealth through brands that the consumer believes they cannot do without. And to get there, you have to advertise upfront heavily, and you have to promote upfront heavily. And all of those heavy upfront investments burden reported profits in a sufficient way that the managements of those divisions often worry about whether or not they would lose their jobs as a result of failing to meet unrealistic near-term prospects. So, for instance, Nestle has long dominated the coffee business. And as such, they have to look out against all threats and all competitors. Nestle looked out about 15 years ago and began to think about the potential for a premium coffee competitor finding room in their global network to launch a potentially successful alternative to Nescafe. They convened a team, gave them a spending command and said, not a penny more, but figure out how do we premiumize and create a system that is exclusive. And off they went, and for 15 years, they lost money. Investing against the income statement, the development and rollout and nourishment of a product that was called Nespresso.
Sure.
And Nespresso took to the grounds after 15 years of negative investment spending, and was a big hit. And today it does $5 billion a year in revenue, and it's one of their key assets.
Well, that brings up another attribute, does
yep.
it not? Which is the capacity to reinvest.
Yes.
That's one of your key attributes. So
yes.
So the point being, the capacity to reinvest means to be willing to invest in a product with great potential for 15 years and not make any money on it? Is that what it is?
Yeah, but by the way, what's happening is, assume that you were making $50 per share all along, and that business that was the $50 per share business was growing at 10%. So the next year it made 55, the next year 61, the next year 68. And that was the underlying result of the core business. And they were then directing that profit over to the startup under their own operation. And so the earnings went from 50 to 55 the first year. They only report 48 because the investment spending takes away 7, let's say. And then it's a bit of a sawtooth upwards to the right. Once you get to a critical mass and you've proved up the concept, you'll press on the accelerator quite sharply and hope it takes.
Another attribute that is kind of related to the capacity to reinvest is the capacity to suffer is a key attribute of companies that you invest in. So what does that mean, the capacity to suffer?
The capacity to suffer shows up in something like Nespresso, where the chairman, Hermann Maurer, over the 15 years of development, shut the operation down 4 or 5 times because the profits were elusive. They hit the wall. They didn't have spare capital to deploy, and they shut it down, only to start it back up, and then over time the balance struck properly, and off they went and never looked back. It was an immensely profitable investment. But the suffering takes place because things don't happen, on a schedule, and they have to suffer criticism, substantial criticism
from Wall Street, right?
From Wall Street, because that's right. So remember, I started with 50 and then went up to 55 and then 60. Well, instead of doing that, which is what the underlying business was doing, they were instead reporting ever-growing losses from the startup. And so by the time you finally have a chance to take the business into the public awareness, you are running an operation that has deep costs, and you don't have revenue yet from the new startup. So when it turns, you have the ability for the investment funds to get the product out the door, and then you hold your breath to assuming you get it right. The other one that has had a similar success has been one from Philip Morris, again, 1992 investment. Philip Morris, over the years, has had to defend against a tremendous amount of regulatory challenges and the like. It's been a decent but not phenomenal investment. 10 years ago, they decided to take advantage of their capacity to reinvest, because no one in the world knew tobacco better than Philip Morris. And over the next 10 years, they reported losses of $12 billion developing a product called IQOS, which allowed for cigarette smokers to quit. There had been all sorts of regulatory and FDA and other services trying to get rid of smoking, but nothing had worked. Along came this product Philip Morris developed, which was a high heat electric blade that went into a small coil of tobacco, and it released to the user the flavor and the nicotine, but no carcinogens. 38.5 million people have switched from cigarettes to the IQOS machine.
All right, so this is Philip Morris International.
Philip Morris International, same story. Capacity to suffer in those years that they were making those investments with only losses attached, and so Philip Morris's profits were under pressure, and they had uncovered expenses, and so their profits were not met.
You stuck with them throughout because?
The prize was so large. One of the businesses that they have inside that new division did 5 million tins of something called Zyn. And Zyn is a pouch that goes in, it has nicotine but no tobacco, and it stimulates and keeps people alert.
So again, another key attribute, total addressable market, the TAM, that you knew that it was this huge market. I think there were 2 more attributes I wanted to discuss with you, Tom.
Yes.
One is tax efficiency.
Yes.
So how is it that a company is tax efficient?
The tax efficiency in investing is what Warren said to our class, which is that there's only one break the government gives investors. It's the non-taxation of unrealized gains. So the goal as an investor is to find businesses that have the capacity to reinvest, whose managements have the capacity to suffer the reinvestment burden, and that the byproduct of all that hard work will be a profitable new stream of business. We want to be at the ground zero when the next IQOS and the next Nespresso come along.
That's another key attribute of yours, and also is kind of the holding period forever. And the final attribute that I know is really important to you, I think over 50% of your 16 companies have it, are family controlled. What is it about family control that is so attractive?
They share in the same view of the future, that it's a good business person's risk to make the investment in jam today, so you end up with more tomorrow. And so many managers, when they get control over that decision, end up spending in a way that enriches their interests, short term, and also salaries, and also, most importantly, the ability to use the purse string to make acquisitions that can be accounted for in a way that allows you to just siphon off money. It's one of those things that you see regularly on Wall Street, and we want to avoid that. And one way to avoid it is to have a family with one voice, redeploying the excess capital from their core business into either an extension from that business or an altogether new business. You see, in most cases, ours have been extension. The coffee business, Nespresso, extension. They already dominated coffee. The cigarette, the IQOS, it's an extension. They already dominate Marlboro. They ran the numbers on Heineken 0.0, and that's more like a product development, but it has the same characteristics. Less today, but more for later.
One investment for a long-term diversified portfolio. We've talked about a number of your portfolio companies. What would you have us all own some of?
It would be Berkshire Hathaway. The uncertainty that has threatened all along to send the shareholders fleeing the company was the possibility that they'd have a really boneheaded decision as to who to serve as CEO of this assortment of assets. That didn't happen. We all know Greg Abel. He's been a part of the community. He's been a part of the decision-making hierarchy. And those who will be reporting to him have knowledge of his character and his command. And boy, that's a big plus relative to a standard succession battle. Second, though I'd say that the steps have been taken to properly organize things, there will be plenty who are frightened, and shareholders of Berkshire should know that if frightened selling takes place, Berkshire has warehoused $300 billion worth of cash, almost 25% of the market value, to be available to reduce the shares outstanding.
So Tom Russo, thank you so much for joining us on WealthTrack and explaining how you pick your portfolio companies, and clearly your strategy is very effective. So thanks for joining us, Tom.
Thank you very much.
At the close of every WealthTrack, we try to give you one suggestion to help you build and protect your wealth over the long term. Recently, our guests have been doing the honors by answering this question: what is the best investment advice you have ever received? In part one of our interview with Tom Russo, he shared Warren Buffett's advice to him and his Stanford Business School class many years ago, which was, you can't make a good deal with a bad person. You can see Tom's full answer on wealthtrack.com. This week, Tom shared his own investment advice for us, also courtesy of Buffett. This week's action point is turn the page.
It's really a gift of Warren, who described a magnificent investment launch that took place over the past 3 years of Japanese conglomerates. He was turned on to the idea by someone, but in his normal manner went beyond all others and found himself with a book that he said was 5,000 pages long, and each page was just numbers. And he just sort of observed them and pulled out every couple of ones and said, this might be interesting. In fact, what he found was a way to make several tens of billions of dollars for Berkshire shareholders. And he said that he still spends his time just turning the pages, to see if there are any possibility that there are any more of these things in between the 5,000 page bookends. And I think that is true of our profession. We have to stay, investment managers have to stay curious, they have to remain mathematical, and they have to have sort of a quirky nature to put in the time like Warren has over the decades, and to find it to be rewarding, both financially and also intellectually.
Buffett is famous for taking financial reports with him everywhere, vacations, trips, and reading them constantly for fun. Continuous learning and endless curiosity are two of the hallmarks of great investors. Next week, legendary investor Jeremy Grantham is known for his prescient market calls. What is he saying now? Please follow us on Facebook, X, and our YouTube channel. We are so glad you can join us. Have a fabulous weekend and make the week ahead a healthy, profitable, and productive one.